Hi, in this video I'm going to tell you the advantages of options trading and how to buy an option contract in simple steps for beginners. Please note that although options trading is extremely profitable, it comes with the downside that you may lose the investment if not executed properly. Now let me give you an example of Microsoft stock. Let's assume that on the day you want to trade, its stock price is $100 per share. Let's suppose that you strongly believe that this stock price will rise in the next 3 months. If you buy one Microsoft share with $100 by direct trading on day 30, when the price goes up to $120, you have a net profit of $20. Similarly, if you can invest $500 on day 1, you can buy 5 shares of Microsoft and can make a profit of $100 on day 30 by direct trading. Now let's check the numbers for options trading. As the name suggests, when you do options trading, you have multiple options. I'm not going to tell you all the options in this video as it can be very complicated and frustrating for beginners. Here, I will discuss just two major options, call and put. What is a call? A call means that you bet that the underlying stock will go up in the next couple of months, and you agree to have a contract for the same bet. Each contract controls 100 shares, and you can have multiple contracts if you have more money to invest. Here, you should remember that you don't own the shares, but you're holding a contract to buy the shares or sell the option contract before it expires. Therefore, the price you pay per share is very low compared to the original stock price. Now, when you're ready to buy a call option, you need to decide the strike price. I will tell you more about it in a minute, but for now, let's say that you want to buy a call option contract at a strike price of $100 and each share costs $1. Since each contract controls 100 shares, in order to buy one call contract at $1 per share price, you need to spend $100 per 100 shares. Now in a month, when the stock price goes up to 20%, the value of your call option contract per share could be $5 at the strike price of $100. The value of your contract will be 5 multiplied by 100 shares equals to 500, and your net profit is $400 compared to the direct trading, which is just $20. Similarly, when you invest $500 and buy 5 contracts at the same strike price, its value will be $2,500 with a net profit of $2,000 compared to $100 in direct trading. Now let's check the other option called put. In this case, you bet that the underlying stock price will go down in the next 3 months. Unfortunately, you don't have this kind of option in direct trading. When you think that the stock will go down, it's better for you to wait and buy the stock when it drops, right? Otherwise, you will lose your money. In options trading, you can make money even when the stock goes down, because you're literally betting that the stock will go down, and if it goes down, you are the winner. The put options work exactly in the same way as the call options, except that in put options, you win when the stock goes down. Now, I will show you how you can buy an option contract. Whatever the brokerage account you have, just click the stock you want to trade and search for the options tab, and you will see a similar page. You don't need to understand all these columns. Just remember two things. First and foremost important thing is picking the strike price. The left side of the strike price is always a call options, and the right side of the strike price are put options. What is a strike price? It is a fixed price where the stock can be exercised. That means when you own a contract call option, you can either sell the contract before the expiration date and take the profit, or you can bring more money to buy 100 shares of the underlying stock per each contract at the strike price of the stock instead of the higher stock price at the time of contract execution. Personally, I would strongly recommend selling the contract and taking the profit instead of bringing more money to buy the shares at lower cost. Now, the share price of the options vary greatly depending upon the strike price you choose. It can be very expensive when you're too conservative, or it can be very cheap if you're taking too much risk. Therefore, it is better for you to pick a price that is very close to the stock price on the day of trading. The second important thing in buying the options contract is the expiration date. Trade options contract expires every Friday or the last trading day of the week, and you can only buy options that expire in multiple of weeks. The longer you pick the expiration date, the more time you give the stock to go in the direction you have bet. However, options with expiration date more than 3 months become terribly expensive. Therefore, I recommend you start buying an option that expires in 3 months. Once you decide these two factors, click on the ask price on the left to the strike price you are interested in case of a call option contract, and bid price on the right to the strike price you are interested in case of put option contract. Here I will show you an example to buy a call option contract at the strike price of $245. So when you click at $20.15, you will see a similar page. This page shows you that you are about to buy one Microsoft stock call option contract at a strike price of $245 with an expiration date of September 16, 2022. I always recommend traders to place a limit order that is in the middle of the bid and ask price and execute the order. As I mentioned before, since each contract controls 100 shares, we should pay $1,990 to buy this contract. If you want to buy multiple contracts, make sure that you change the number in the quantity section. So lastly, I want to give you some tips for successful options trading. While picking the strike price, you have to be very conservative. You should pick the strike price that is very close to the current stock price or a little bit lower than the stock price in case of call option, or a little bit upper than the current stock price in case of a put option. And you should always buy options contract that expires in 3 months. No matter what, whether it is a call option contract or a put option contract, you should buy a contract that expires in at least 3 months. Remember that if the stock goes in the opposite way than you predicted, you will risk the entire investment if you wait until the contract expires. Therefore, I always recommend you to take loss and come out. You should not wait for the expiration date because you may lose the whole investment. Never be too greedy in trading options. You have to be very disciplined and you should calculate the risk or reward and stick to it. And that's it. Thank you very much for watching my video, and I wish you good luck from Zero Nonsense. If you like my video, please subscribe and leave a comment. Thank you.